Well, welcome to my Laundry 101 podcast for commercial laundries. I'm your host, Ray Hayes. Today I'm just going to touch on selling your business. Now, I've seen lots of commercial laundries go on the market over the years. I've done quite a few acquisitions myself over many years, approximately 24 exactly. Now, I'm just going to touch on some common things that operators miss when they're putting their business on the market, and had they have paid more attention to what an astute buyer is looking for, they could have increased the value of the business and their return, obviously. Now, we're going to talk about the business as if it's an astute business person wanting to buy it, or astute investor wanting to buy the business. And for the examples I'll give, we'll just assume that they're paying cash for the business. Now, that straight away sort of lends itself to a pretty clear picture that if I'm an investor and I'm going to buy a business, it's I don't know, between 50 and 200 tonnes a week. So anywhere between, say, $1 million and $20 million for the business. If I'm going to buy the business and I'm going to pay cash, I'm going to look for a good return, and I'm not going to be wanting to be caught up in the business day to day. So the first point of any person wanting to put their business on the market is to understand what the free cash would be for somebody buying a business in cash. Now, we'll run through the detail of what that looks like when you're looking at your P&L or your balance sheet. But first off, what an astute buyer will look at, they want to make sure that the revenue that they're buying is maintained over a long period of time. They don't want to spend multiple millions of dollars buying a business and then the next day find out that the customers have cancelled the contract or have no contract and can easily sort of walk away. So the first line item to sort of drill into and prepare is the quality of contracts of your customers. Do you have contracts? What's the term of the contracts? How many years do they have left to run? And quantify them. Break up your revenue to your top 20 customers and list it off in dollars, and then break down their contract term remaining. Now, that's very important. And the other important thing about these contracts is how many times they've renewed with you. Because if an investor coming in sees a high churn of customers, or that you win a new customer and then at the end of the contract they've moved on. So an investor will look at the quality of your current revenue, the contract terms, the length of the contract remaining, and also they'll look at the number of customers that you've lost over the last 3 to 5 years. So that's important. The least number of customers that have moved on, the better. But sometimes there's quite valid reasons why customers moved on, and it's good to have notes around that. So you imagine an investor's coming in, they're going through your contracts in a due diligence stage. They see that you've had a major customer move on 2 years ago. They'll want to know why. And if you've got the answers at your fingertips, that's what you'll need to satisfy an investor, that you understand the market. Then they can be reassured that the commentary you give them about your current base is reasonable, because you've understood why the customer's moved on. It might be that laundry down the road cut the price, that style of thing. So quality of contracts, term of the contract remaining, price increases in the contract, any additional charges that you can charge under the contract if your cost line increases, extraordinary, which has happened over the COVID period and also recently with oil prices and gas prices. So understand the contract itself that you have with your customer. Now, if you're going to put your business on the market and you don't have contracts, highly recommend you at least get a one-pager in front of them for the rest of the for another 3 years or whatever you can negotiate with the customers. So then the next point, you've got the top line sort of covered with any opportunities out there as well, but your current revenue is solid, and you've got some commentary that you can add if you're questioned around that. The next point will drop down into your cost line. Obviously, labour is an important one, so they'll drill right into that. Your labour cost per kilo is important to understand that. Your any claims you've had, workers' compensation claims, so really your whole HR bucket, so to speak. If you've been into Fair Work or got any Fair Work issues, have those sort of qualified in terms of, is there any risk outstanding with any claims that you've got, or have they been settled, that type of thing. So they want to make sure you're compliant. So how you run your payroll each week, what tools you're using, whether you're using some software, MyOb, there's a raft of different payroll software. It's important that that's measured against the award, in Australia, the Commercial Laundry Award, to make sure that you're compliant. After they buy the business, if the transaction goes through, that there's not going to be any claims from employees coming back in that they were underpaid. So that's vitally important. And so I'm just going to drop down the cost line as we go and just expand each one briefly about what's important when an investor comes in and has a look. So the next major cost in terms of a commercial laundry's P&L is linen. Now, this is one of the most scrutinised line items in a P&L for any astute investor. As operators know, that every month we're investing in linen to inject into our pool or into our customers' stock to maintain that at the correct levels. Now, what a lot of laundries don't do, and it really detracts from the overall value of the business, is separate the cost of natural depletion. In other words, if there's no growth in the business, you assume the business didn't grow, what amount of linen did you put in over the last 12 months to maintain that pool? Now, if the revenue did go because you've onboarded new customers, what was the cost of that linen that you purchased to take on that new customer? So I break them down as two costs in the line item. One is natural depletion, and the other one is growth capex. In other words, linen that you bought to grow the business revenue. Now, on that same line item in your P&L, we'll then jump to your balance sheet, because this is very, very important. Because on the balance sheet, it'll show your linen as an asset in line with how you're treating depreciation of the linen that you buy. Now, most laundries write their linen off over 2 years. You write it off sooner, but I think the Australian Tax Department sort of allows self-assessment on this. My view is you should write it off over 2 years. So we'll just park that comment for later on, but the linen value on your balance sheet, I wouldn't bring into the discussion with a customer, with a potential investor, but they will try and bring it in. So, and I'll talk to you and I'll unpack why a bit later on. So then you've got if we move down your cost line, you've got your other variables, your gas, water, electricity type things. So having your contracts for those at hand, understanding what the potential increases are when they're due. Gas contract's a good example. If it's due in 18 months, get some expert advice for whether you think that that will go up or down. Now, why that's important, if you're looking at an investor that's looking for what's the free cash going to drop out of this business that they're going to buy, if they're looking to the future, and you could substantiate that my gas contract, my current prices will come down, so the free cash will increase. So that sort of talks up the value of your business as it goes forward. So there's a distinct line in the sand you're drawing that my business up to this point, my cost has been X against my revenue, but going forward it may come down in some line items. Wages obviously go up every year, so efficiency and things you're doing around productivity on your wages is an important thing to have dot points that you want to raise. You might have put in some equipment that's going to reduce your wages, but up until a point in time in the cost line and the P&L that they're looking at, that equipment wasn't in there for the first half of the year. So the second half of the year, your labour might be reduced. You want to do a run rate on the last half of that financial year. So you can substantiate why you think your costs will reduce, and if they're going to increase, you want to tie those to increases in your prices for your customers. So the margin either stays the same or increases over time. So then we're going to drop down to the EBITDA line. Now, I'm going to tie the linen back into this, as I said before. The EBITDA line is what a student investor will be looking at. So that's earnings before depreciation, tax and accruals. Before interest, depreciation, tax and accrual. They're paying cash for the business in this example, so no interest. Depreciation is just an accounting fee that you can adjust your P&L down with to allow for wear and tear on equipment, but in terms of invested, that won't be paid out immediately. It'll be a free cash line item that'll drop to the bottom line. Now, tax, we all got to pay tax, but they may have other tax deductions that they can bring into the business. So we assume that the business is not paying tax at the EBITDA line. That'll come after. And accrual, so anything like long service leave, sick leave, that's accrued but not paid out, so we take that out as well. So you've got this EBITDA line, which in theory should equal free cash. So I pay cash for the business, and then each month the EBITDA line is the cash I put in my pocket, and then I worry about depreciation, interest, tax and accruals after that line. Now, I just want to bring linen into this. The tax department lets most businesses put their linen cost below the EBITDA line, and why they do that is because we accrue it on the balance sheet, so it's an asset, so it comes into the depreciation line. So most laundries have their linen expense below the EBITDA line, but we all know that we have to inject linen on a monthly basis, so it is cash coming out of the business. Now, I would put, if I was selling my business, I would do the EBITDA, which would equal free cash. Underneath that, I would put natural depletion linen only. Growth capex I would leave out, because that's capital that you're buying linen to grow the revenue, so I'd park that to the side. I would recognise it, but not in terms of free cash, because someone buying your business may say I'm not going to grow it for 12 months. So therefore all they have to inject into the business is natural depletion to keep the current stock levels at the right. So I hope that's clear. So we've got EBITDA equals free cash, linen, natural depletion linen just under that, but it comes off the free cash in terms of an investor looking at how much the business will return. That'll come out of that free cash at the EBITDA line. So very, very important that you have a look at your balance sheet, check with the accountant how they're treating depreciation, because the last thing you want to do is be depreciating your linen over beyond its natural life. Now, as I said, in Australia, the tax department lets you self-assess that. I would bring it as short as possible for obvious reasons. Now, the other thing, we then move to your equipment. So we know your revenue, we sort of understand your costs, we understand the free cash. So an investor coming into a business is going to want to know, will the equipment last me another 5 years, 10 years, 20 years, or 1 year? So knowing the average life of your or equipment is very, very important, and you need to put that in brackets. Now, if the equipment is old or aged, then you're in your P&L, where you've got your maintenance line, break that up into two subheadings. One, your labour for maintenance, and two, your parts for labour, your parts for maintenance. Now, why that's important, it might have been a bad year. You may have blown a motor on press, or an ironer, you've had to replace the main drive motor or something, and you've got some big expense in there that you may have just written off and not accrued on your balance sheet. So go through that parts history for your maintenance with a fine-tooth comb. Capitalise anything you can. Pull it out of your cost line, but understand your labour for that. Now, why this is important if you've got old equipment, if your OPEX, your operational CapEx for maintenance is under control, you're spending the money and you're maintaining the equipment in good condition, the age of the equipment is not so important. But it is important if you can't justify that you're maintaining it well, and it will last another 5 10 years. So what I'm saying there is, if you've got brand new equipment, not a problem. Under 5 years, just state under 5 years. Your maintenance line then doesn't really come into question. But if your equipment is old, drill into your maintenance, separate your cost of labour for maintenance and your parts, drill into the parts, capitalise what you can, and try and build a narrative around, yes, my equipment's old, but we maintain it well. Here's the evidence for it, and it'll last indefinitely with this type of maintenance schedule. So they're probably the key items that I would look at. Lay them out practically. Look at your contracts in your business. Understand your linen injections into the business, whether it's growth CapEx or natural depletion CapEx. Understand your energy supply contracts. When are they due? How long do they have to run? Will they go up? Will they go down? Age of equipment. Your wages. Do you have any claims on wages? Are you compliant? You need evidence to validate that you are compliant with the current awards. So these are the types of topics that most businesses sort of gloss over. If you've got detail in there, then it makes the due diligence process a lot easier. And then the next big item that an investor will look at is, what were you paying yourself? Is it in that cost line for the business, or do I have to add back some for appointing a manager? And what is the succession plan? If you weren't there tomorrow and someone came in to run the laundry, or bought the laundry that didn't know how to run a laundry, what's the quality of your leadership team within the business? Now I can't stress how important that is, because, for example, if an investor is going to pay $10 million for your business, they're not going to want to be there every single day on an ironer, in the sorting room, managing, or on the floor managing the production. They want to manage it at a high level. So the quality of your leadership team outside of yourself is vital. You may negotiate that you stay on with the business for a period of time, but what I have seen, virtually 100% of the time, when a person sells their business that they built to work for a new owner is extremely difficult. They have different ideas. They've invested a lot of money, so they want things done their way. But it's super, super important that you plan for that question, because if you don't, and you don't have a succession plan, as I said, most owner-operators that sell their business will only last 2 years under new ownership in general, from my experience, from what I've seen. So get your succession plan in place. Have your production manager, your team leaders trained up. They may ask when you've last taken a holiday, how long it was for. So they're the sort of key elements. Now, that sort of talks through the EBITDA line, what the business is worth. Now, the other thing that will play into it, most people that want to buy a business want to grow it. So you have to understand your available capacity. How many hours a day is the plant running now? Now, if it's 6 till 6 within the sort of the cheapest hours under the award, that's good. You can just extend the hours to produce more volume. But if you're working Saturday, if you're not doing 6 to 6 Monday to Friday and you're working Saturday, that's a red flag that you don't have enough linen. So start to think about that. Now that's a whole topic on its own. I'm going to do another podcast on what an investor, as me looking at businesses, what I was looking to see if the business was a stressed business or not. So this one's from you, from an operator trying to sell their business and get the maximum value for it. If you've got all these boxes ticked, you'll be able to validate your asking price. Now, I'm going to, as I said, do another podcast looking through the other eyes. If I'm going to buy a business, what I look for in a business that's will be indicators that the business is stressed or not stressed, and that will be worth a look at to see if you're going to put your business onto the market, what an investor might be looking at if you're not prepared. Right, I've gone into businesses and can tell within an hour that the business is under stress by asking a few pointed questions. So that's a wrap for this one. So we'll line up for the next one. It'll be delivered very shortly on what to look for if you're wanting to buy or acquire another business.